Welcome back. If you've looked at your 401k or your brokerage account lately, you might be asking, where is the money? The markets have taken a dive recently, wiping out lots of gains. But there's one thing we know about the stock market: what goes down often goes back up, and vice versa as well. Joining us now to talk more about this, CEO of Hobart Wealth in Ballantyne, Chris Hobart. Chris, thanks for coming on. We appreciate it.
Oh, definitely happy to be here.
All right, so educate all of us. What in the world is going on?
Well, here, let's be realistic about this. Right now we're kind of dancing around what's called a bear market. And a lot of times people get worried about that because obviously it sounds scary. A lot of times people think that when we go into what's called a bear market, it guarantees a recession. And the good news is, historically, a bear market has always preceded a recession, but a recession does not always come from a bear market. But I think the big question is, what is a bear market? And all a bear market is, it basically says that in an index, that the index is down 20% from its high. So if we look at the Russell 2000 or the NASDAQ, which are both tech heavy, they're both in bear territory, pretty significantly in bear territory. But if we look at the broader index, which is the S&P 500, well, the good news is we've danced around. Last week, we actually touched bear territory, but right now we're at about 16 to 17% down. That doesn't feel good. I understand that. But I think if we put that into perspective, it can be much more understandable. In fact, since 1945, we've actually had 14 bear markets. So it's not an oddball thing for us to experience. They happen about once every 5.4 years. And the average bear market, to also put that into perspective, it lasts about 11.3 months. And the average drawdown during that period of time is about 32%. So again, not easy, but here's what I want people to keep in mind. The average bull market, that's when the market's moving forward, that average length of time is 4.4 years. So bull markets last a lot longer time frame, and the average cumulative return over a bull market's run is about 155%.
Okay, let me stop you just real quick because we're going to run out of time. What do you recommend for like your clients out there? What do you recommend for folks listening at home? What do they do in a situation like this?
Yeah, definitely. First, let's not panic. At the end of the day, panicking converts short-term pain into long-term misery, and you don't want to do that. The main things you need to be doing right now is let's look at your allocation. The past 10 years, the market's really been strong on equities. Let's make sure that you have a proper balance of big companies, medium companies, small companies, as well as fixed investments. Something else to consider, depending on your stage of life, make sure you have cash on hand. If you are near retirement, don't have all your money in the stock market. Have a portion of money on hand that you can access because you don't want to be liquidating during negative times. The other thing that we want to do is don't overcheck on your accounts. Oftentimes when the market's going down, you keep looking, you get feared or afraid of what's going on. The key here is have a long-term plan and stick to that plan. And in this case, that's oftentimes where a financial advisor is going to be most helpful in helping develop and build that plan. And then most importantly, making sure you're on the right track for the long term.
Yeah, so be careful about looking at your 401k too often because it might trigger you in ways you don't need to be, and let a professional handle it. All right, Chris Hobart. Chris, thanks so much. We appreciate it.
Thanks, bud.